إن الحمد لله نحمده ونستعينه ونستغفره ونعوذ بالله من شرور أنفسنا وسيئات أعمالنا من يهد الله فهو المهتدي ومن يضلل فلن تجد له وليا مرشدا وأشهد أن لا إله إلا الله وحده لا شريك له وأشهد أن محمدا عبده ورسوله. All praise is due to Allah. We seek His assistance and forgiveness. And may Allah's peace and blessing be upon His Prophet Muhammad sallallahu alaihi wasallam. I'm here today, my name is Basim Abdullah. I'm here to give a presentation about Islamic finance and guidance residential. We're going to start with a brief introduction to guidance as a company, and then we're going to get into Islamic finance, and then we're going to answer questions. Guidance Residential today is the leading Islamic finance provider in the US. Guidance started operating in the US since 2002, and today is operational in about 23 states. We have provided more than $3.5 billion worth of Sharia-compliant home financing. The company's objective is to provide and address the unmet needs of Islamic finance in the US market to Muslims, and this is through a unique and a soundly designed competitive Sharia-compliant program. Now, this program has been designed by a Sharia supervisory board, and the board consists of a group of scholars from different parts of the world that specialize in Islamic finance. And those scholars, along with law firms, have helped design a very unique contract that is addressing the Islamic finance needs in the US, and at the same time is compliant with the federal laws and rules and regulations that monitor this business. We are trying to get the monitor working. So this is up now. So like what we were saying, basically guidance has been operating since 2002, operational in 23 states. By far is the largest Islamic finance provider in the US. Guidance started this by using the expertise of Islamic finance scholars from different parts of the world. They designed a program or a contract that was very unique, and also with the help of law firms as all understand, the mortgage industry is an industry that's highly regulated by the U.S. government, the federal government. So now here we have to provide a contract that is Sharia compliant, very sound and very strict Sharia compliant that meet the needs of Muslims in the U.S., yet is something that will be acceptable by the federal government and would allow the company to operate and provide this finance. In terms of the differences, now to start with, we have to understand the problem that we have with regular bank financing to understand how Islamic finance works. Now, regular bank financing, regular banks are what's called depository institutions. And those are institutions that's only allowed by law to either take deposits or provide loans. So when you go and seek a home finance through a regular bank, basically what you're doing, you're applying for a loan. You're asking those guys to give you a loan that you will use to buy a home. Now, when the contract that's going to be between you and them is strictly a money contract, you borrow an X amount of dollars and use this money to buy a house, you become 100% owner of the property, and then the relationship with you and the bank will remain the money. Now, this in itself, from an Islamic point, is problematic because there isn't a loan in the Islamic laws that's permitted to generate profit. So anytime you will take a loan with the condition that you will return it with an increase or with more than the principal amount, this is basically, the increase here is what's called the riba. The word riba in the Arabic language literally means increase. So, and the word in itself is not a bad thing, it's not a bad word. It really means increase. So increase in a good thing is okay. Increase over a money loan is highly prohibited and is one of the things, in fact, it's the only thing that Allah decided to wage war on people who do this. So now, Islamic finance, that we understand this, Islamic finance, very simply, the goal is to avoid loan. Simply put. If you avoid the loan, you've avoided the majority of the problem. So you would find all of the Islamic finance models simply trying to do a structure of finance that's not involving lending or borrowing, it's not involving a loan. Guidance uses the Musharaka model of the Islamic finance. This is one of the most popular models. It's a co-ownership model. There is also a couple of other models there is a lot of models, but 3 or 4 of them get to be very popular. The Musharaka is one of them, the Murabaha or purchase and resale is the other. There is an Ijara or something very similar to a lease to own. Guidance uses the Musharaka model of the Islamic finance, and the Musharaka, from its name, basically we will go into a co-ownership with you buying the property. As I said, again, just for you, if you get an understanding of how this works, it's going to be very simple. Islamic finance is very simple. So once you avoid the loan, there is no lending or borrowing. Basically, this is majority of the problem solved. So the Musharaka model here is that the home of your choice, you're going to come and say, okay, I have that much toward the purchase of the property. We're going to complete the price and go purchase the property with you as co-owners. At no point we lend you money. At no point you're in debt to us. We buy the house as co-owners. And then now the contract that's going to be between you and Guidance is simply going to be an agreement of how you're going to buy out Guidance share of the property. You're going to every month buy a part of Guidance share, declining their ownership balance and increasing your ownership. While doing this, you're also, since you're going to be enjoying the entire property, see guidance is going to move up, you're going to be enjoying the entire property. Now, you're going to also pay them what's called a utilization fee. Utilization fee, a lot of people like to call it rent. It's not really rent, I say, but in the contract is called a utilization fee. You can call it a usage fee. So simply you're paying them in return of using their share owned of the place till you complete buying the house or till you acquire 100% ownership of the property, or till you decide to terminate the contract by selling the property or refinancing. Now, there is a good deal of similarity between the amortization of a regular bank financing and what we do here. Now, when it comes to, a lot of people get stuck on, okay, how do you calculate this, how do you calculate that, how is your payment being divided? Now, that's why I started with introducing the difference, right, and what's the problem with the regular bank finance. Now, when it comes to math, math is math, like 1 + 1 = 2. It doesn't matter how you calculate your profit. What matters is the method and the structure of the finance. This is what makes it Sharia compliant, or makes it Islamically okay, or not okay. Similar to everything else when it comes to the Islamic laws and rules. You apply this on everything. Sometimes the difference between this and that is a very thin line. And the most popular example is the halal meat, right? Like to halal meat, to us, what makes it halal is the method and the way that the animal is being slaughtered, right? Or being killed. Now, if it's being done the right way, through dhabh and tazkiyah, then this animal is halal meat to eat to us. Now, if it's being killed in any other way, being shot, you hit it on its head, well, it becomes dead meat, as prohibited as pork to us, right? So the method is or the way that you conduct something is what makes it in compliance with the Sharia or with the Islamic law or not. And similarly to what we're saying here. Now, the contract, the structure of the contract being a co-ownership contract makes a huge difference in your rights and the finance party rights. So for example, in a co-ownership contract, the finance company or the partner will share in what's called forced sale losses. All types of forced sale losses will be shared. Eminent domains, natural disasters, things like that. Anything that you can apply to a forced sale scenario to, which is unlike in the regular bank scenario. In the bank scenario, because your relationship is the money, and the contract between you and the bank is a money contract, the bank really will take no losses whatsoever. You are responsible for 100% of the loss. So if any loss happens, whether it's forced or not, the bank will come after you and tell you, I need my money back. I gave you money, you signed that you're going to return it, and I need my money back. And this is basically the way they come after you. They come after you as a debt collector. When they go to court, they say, we give this person money, he signed that he's going to return it, we need our money back. And so this is basically the structure of the co-ownership here would not allow that, because we did not give you money at any point. We went with you into a co-ownership buying a property. Now, if a loss happened here, provided it's a forced sale kind of loss, we will walk away with the loss. We have nothing to ask you for, simply put. So this also applies to something called in cases of the losses, we cannot come after any assets that you own to recoup losses from this sale, from this forced sale. Which is unlike in the bank scenario. The bank, again, like we're saying, it comes after you as a debt collector, so it will go beyond the house. If it doesn't get all of its money back from the property, from the sale of the property, basically they can go after any other assets, bank accounts, wages that you might have. So this is, I mean, in simple terms, explaining how the differences between Islamic finance and regular bank financing. If you guys have any questions? Yes?
You said there is more than one way. Which are the other ways to finance through guidance?
No, guidance uses, I'm saying there is different methods of Islamic finance in general. Like the murabaha or musharaka or ijara. Guidance only uses the musharaka model of Islamic finance. They find it to be a model that fits the mortgage industry in the US very well, and it works with it very well. The musharaka model of Islamic finance is basically the co-ownership. The program is called the declining balance co-ownership agreement. Yes, go ahead.
What is the utilization fee?
The utilization fee, basically now your monthly payment is divided similar to the conventional. The monthly payment is divided into two portions. Now you make one fixed monthly payment throughout your contract. Let's say it's $1,000. It will be divided into a utilization, and this is what pays for the usage part. Or you using or utilizing guidance owned space of the property, and you will also pay acquisition, which is you're paying to acquire more ownership of the property every month. So this is the two portions that your payment will serve. Two independent portions that your payment will be divided into. Yes.
Is there a higher percentage versus with the guidance loan that you put down up front versus a regular bank loan?
No, actually guidance has been for the past, I would say, at least for the past 5 or 6 years since they established their contract. Now they have been very competitive to what's being offered in the market, and this is their promise. So that they will offer you something that's very competitive. They will work on matching offers that you might see outside, whether from regular Islamic finance companies or conventional bank financing. But their offer basically is that, in general, they're being competitive with what's being offered in the market on average. Yeah, go ahead.
Where does guidance get its money from?
Okay, guidance Residential is a part of a group of investment companies owned by a mother company that's called Capital Guidance. From Capital Guidance is Guidance Investments, and Guidance Residential is a part of those groups. Now, so Guidance started their finance and their business with their own money, with money from the mother company, Capital Guidance. And then afterwards, now there will be investors that will come in play. Investors will invest into the contract that's already being financed and closed, and this will provide liquidity and more ability to finance more homes. So they started with their own money that's being coming from the mother company. Yes, sir.
So let's say we do a 30-year co-ownership, right?
Right.
If you translate that into a 30-year loan, what would the interest rate be? Or just not using words or definitions.
Yeah, we would have actually a rate that we calculate our payment based on, and it's being benchmarked. You see, we're not directly linked to the market. So we don't get our rates directly from the index or the stock market like the regular banks do. But what we do, we have a department that specializes in that they will every day benchmark against the market. They will see what's the 5 major players or what's the average that's being offered in the market. And then they will come with a rate that will be competitive to that within the affordability of the company.
And we're not stuck in the 30-year, right? It's not.
No, there is no prepayment penalties, there is no restrictions on early pay. You can take a 30-year contract and pay it however fast you choose to. You can pay it in 5 years, you can pay it in 10 years. And obviously, because you're paying the utilization month to month, this will result in, the faster you pay, the lesser overall cost you will have. Yes?
How's the payment change with the economic changes? Like in 2008, in the housing crash and the recession, you would think that the value of homes went down.
Right.
What happened to your company?
Actually, in one of the things that the company is, we have a very unique program, and we did not get into a lot of the schemes that the market was using. And so we were able to stand and operate and stay in business in a market that you have huge companies that failed and went bankrupt. So actually we were not affected at all. In fact, our portfolio was doing very well. We were not affected at all. Of course, you would have few homes that went into short sales or foreclosures, but overall, I mean, you've seen huge banks and huge companies that were playing in the 100 billions, and they simply couldn't stand this financial issue. But alhamdulillah, we did.
Compared to the conventional loan, by the time you finish paying off the mortgage and the house, it becomes like 3 or 4 times.
Right.
So you said you buy the like shares on a monthly basis.
Right.
How does it compare to the conventional loan?
Well,
by the time you finish paying off.
You see, like I said, the math is pretty much the same. The math is math. Here, we are providing a finance that's being done in an Islamic Sharia compliant way that will meet your needs and provide you with this peace of mind. Now, in terms of cost, it might be a little less, or it might be in some cases a little more, but overall, it's in the ballpark. It's in the same range. Now, like I said, the math doesn't have much to do with how Sharia compliant it is.
And how does it differentiate then? How do you differentiate between the conventional loan and this? I'm not understanding that. When you say that, you buy the share,
yeah,
it comes down to same level by the time you finish paying off.
Yeah.
Can you tell me how do you differentiate?
Same level. When you say same level, you mean cost?
Cost, yeah.
Yeah. So again, like I'm saying, the cost here is not a measure of the contract being Islamically correct or not. The cost is something we have to, we offer a competitive, so it's not, we are for profit financing. We are not a company that's offering a non-profit business. However, we are trying to provide something that's very competitive to what's being offered in the market. Now, again, when you keep going towards the math and the numbers, it's pretty much the same. I mean, what's the difference between when you have 2 pieces of meat, halal meat and non-halal? What's the difference? How can you differentiate between the 2? I mean, the difference Islamically, when you're compliant with the Islamic laws, is in following the methods and the laws that's being that's in place by the Islamic finance. Yes, sir.
Who will buy the insurance? It's guidance buy the insurance, or homeowner have to buy the insurance? Or no
insurance, you mean the
disaster insurance for the house?
The disaster, okay. Now, as we said, we are into a co-ownership contract. When this contract was designed, the scholars, and this is a question that comes up a lot. Do we share in this? Do we share in that? Now, the scholar said that we would have to offer you to share in the insurance, but you would be responsible for the taxes paid for the property. Now, so we offer. However, I would say that almost like 100% of customers will choose to get their own insurance. And then your own insurance on average is about $50 a month, $60 a month. This is the insurance that you get through your regular car finance, car insurance company, Geico, Allstate, those guys. This is the hazard insurance you're talking about, right? So yeah, this insurance is relatively cheap when you get it on your own through those companies. Then if you get it through, because I mean, it gets to be more complicated and more expensive. If you decide the guidance would share with you. I mean, I guess guidance being on the contract turns it into some kind of commercial.
So insurance and taxes are part of the owner, not
Yes,
the guidance.
yes, it's on the home. The person
There is
who
guidance on the home, but the insurance and taxes are going to be paid by the owner.
yeah, guidance is co-owning the home. You own the
Right, but
the
initially
home.
it's owning like 99% from very first day. If you think of in the beginning, guidance is going to own 99%.
Right.
Whatever.
Right.
Yeah,
Like I
there's a
said,
percentage
like I
limit.
said, we will offer you to share in the insurance, and you will have to decline.
So it's
If
going to
you
end up in the utilization money or whatever you are charging.
the
So
utilization.
you're going to increase the utilization
No.
cost.
It's something that's separate. But in the disclosures that's being sent when you start the contract, you're being offered to share in the insurance with us, and you would have to either accept or decline. Like what I'm saying is that majority of people choose to decline because the insurance that guidance will be a part of ends up usually being quite a bit more expensive.
What about the investors who are investing the guidance? How they are getting their share back? Those investors who are giving money to the guidance to invest in the houses, how they are getting a percentage, or how they are getting their, like, if suppose someone wants to invest money to the guidance, is he getting interest back?
It's not offered for public investment.
You understand that?
No, I mean investors are
The
private.
investors who are giving money to the guidance to invest for you to invest in the houses, your money pool is coming from investors, right?
Our money, like I said, originally guidance money. There are investors that come and play afterwards.
So
I will explain this
how they
point
get-
in a minute. Just let me think. Yeah, yes, sir.
In a traditional loan, the interest that you pay on the loan is tax deductible.
Right.
Utilization fee, is that also tax deductible, or?
Utilization fee is tax deductible, yes. You see, the things, we will have to use the same form, you see, that the IRS provides for you to get this. We will simply put the what you paid in utilization over the year in the form where it says interest paid. Now, this is a form that is provided by the IRS. You cannot change any of its form. Any federal forms, it's just like you cannot use different forms to do your tax returns. So you have to use the same form. Now, the IRS code is that anything that's not going toward the principal of the property is tax deductible. Right? So all of your utilization will be put in this form, and you will get the tax deduction. Yes. Yes, go ahead. Yes, sir.
What's the minimum down payment?
Minimum down payment is about 5%. Soon we should have about a 3% available down payment as a minimum. 3% would be available, and now some scenarios would require higher down payment. It depends on the type of property you're buying. Of course, if you're buying an investment property, it requires a higher down payment, but minimum down payment is between 3 and 5%. Yes.
How do you determine a credit worthiness of an individual applicant?
Well, we check your credit.
Is that standard, like looking at credit, etc.?
Yes, I mean, we would require, obviously, you see, the credit here is a way to determine or calculate the risk going into business with the individual. So we would require a score somewhere in the mid 600s, which is not too hard. Also, you would have to have no serious issues like recent bankruptcies or foreclosures or so. But about mid 600s is what's needed.
Do you do construction loans as well?
I'm sorry?
Do you do construction loans as well? Or?
The construction, you see, the key here is in loans. You see, Islamically, we cannot do loans, period. If anytime you hear Islamic loan, you would understand that the person who's talking is really not understanding what he's talking about. You cannot give out a loan and expect an increase or a profit on the return, and it is Islamic. This is the form of a riba loan. So construction loans, rehab loans, any loan, any word that has a loan, we cannot deal with, unfortunately. But when it comes to construction, there is a lot of solutions that we have. When you contact us, simply, in many cases, you would have the builder finance the construction, and they are, I mean, from what I dealt with, 95% of them would be willing to, and we would close on the day of the delivery of the property. So we would have the money ready on the day that we say the house is ready to be delivered, and most of them will be okay with that. So you would give them a deposit, they will do the building, finance their construction. We will come in with the funds at the day of the closing or the day of the delivery of the property. So this is usually works in 99% of cases.
Yeah. Since the guardians and the homeowners are co-owning the house,
yes,
and you know that home can appreciate in value or depreciate in value.
Right.
So supposing there is a situation whereby the home appreciates a lot,
right,
let's say by 20%,
right,
and the homeowner decides to sell the house.
Yeah, very good question. I got it.
So now, how is the dividend going to be divided since the homeowner is only using a certain amount of money at that given time of selling the house?
Right. Now the brother is asking, he bought the house. The house appreciated in value 20% or more. What happens if he decides to sell the house? Now, as we said, it's a co-ownership. Guidance will share in all types of forced sale or losses, right? However, we will give up our rights in equities. We will not share in equity. So all of the equity is yours. Now, this is something that we do for competitive reasons, to give people more incentives to come with our finance versus the regular bank finance. Now, the bank financing obviously will not share with you in this because they have nothing to do with the house. They make sure they differentiate themselves from the house so that in cases of losses, you're responsible for 100% of it. But ours, like I said before, our structure, the structure that the contract is designed in, being a co-ownership structure, and we never gave you money, we cannot ask you for money in these types of losses. And the word that I lost when we were the non-recourse. We are a non-recourse contract. Non-recourse is something that's very important, and also by the structure. All of that is not generosity from the company. You know, it's by the structure we cannot be recourse, and we cannot share in those types of losses. Now, non-recourse means in cases of, let's say, you see all of those foreclosures that happened in short sale, when the bank take the house from the homeowner and sell it usually in an auction or so, usually there will be a balance. The guy financed 300 and the house sold in auction for 200. So what happens to the 100,000 difference? A lot of people think that once this is done, it's over. No, you still owe the money. Yeah, so this is something a lot of people are coming to find out after 5 years or 6 years after a foreclosure. The bank is now coming and asking them for the difference. And now this is because, again, it was a money contract. You borrowed money and you said you promised to return it. Upon this foreclosure or short sale, if you do not get, or if this person get a forgiveness of the difference from the bank, they still owe the money. Legally, the bank will take you to court, you still owe the money. There is a very interesting article, if you guys will check, and it was published on the Wall Street Journal. It's titled, "The House is Gone, but the Debt Lives On." This is in 48 states. In the United States are, with the exception of 2, California, and I'm not sure there's another state. California and Minnesota, those 2 states are non-recourse by the law of the state. So California would not allow this by law, by the law of the state. However, 48 states, you're on your own. I mean, if this happens, you still owe whatever the balance that's remaining off of the short sale or the foreclosure. So this is from the benefits of being in a co-ownership versus a loan. Yes, sir.
In the state of Illinois, your maximum loan is what, 417,000? Do you guys have a program that allows
417 in Illinois? Oh, Illinois what?
Yeah.
Yeah, this is called the conforming finance limits or loan limits, and this is something that is determined by investors, and actually something that have like federal government involved in, and Congress and stuff like that. So those limits, unfortunately, I mean, there is nothing that we. Those are the limits that is set by the investors. Yes.
So for the utilization fee, as a person buys back more percentage of the property, does the utilization fee decrease as the guidance is owning less of the property?
The utilization fee, now your payment, like I said, will be divided into 2 portions. A portion that will go to buy you the shares, and a portion that will go toward the utilization. Now, this schedule, the 300 and in the case of 30 years, 360 payments are preset. So, and actually we do give you, by law, this is by the federal law, we have to give you an amortization schedule that will tell you payment by payment what goes to what. So, yes, I mean, every payment you're owning more, and you're renting or utilizing less. So every payment, the next payment, you find that the part that goes toward your acquisition is more, the part that goes toward your utilization is less. This is similar schedule, similar to again, has to do with the math. So it's very similar to what's being the way it's being done in the conventional law.
And then just a quick one after that.
Good, yeah.
Is it possible to stay in co-ownership, or do you have to pay off the acquisition fee?
I'm not sure what you mean.
So for example, if I wanted to buy an apartment building,
right,
and for some reason I wanted to stay 50-50 with guidance, is that possible?
No. No, I mean, this is going to be a financing that is close-ended, and it will have to be done at some point. Basically, according to the agreement, the agreement have a time frame, right? So by such and such date, you're supposed to be paid off, and guidance is out of the picture. But also apartment buildings we cannot do.
What's the repercussion for not meeting this?
You can refinance. You can always refinance and do, for example, a cash out or something like that and stay in the loop. Yes? No.
How does guidance calculate or set the amount for utilization fee?
Utilization fee is being set. We use a rate that's being benchmarked against the market. So we check what's the average market is going on, and we come up.
Average market for what? The home or
the regular mortgage average market, regular mortgage market. Yeah, and this is the only reason we can come up with our own thing. You know, we can decide just out of the blue that this is how much we're going to charge. But the reason we look at those guys is to be competitive and fair in our offering to our community, right? So we are still, you see, which is, it's not a bad thing. A lot of people would still compare us to regular banks. They would still compare what we're offering to that. It's not a bad thing, right? They want to make sure that we're not overcharging, we're not taking advantage or any of that. So from a business standpoint, we have to keep that in mind.
But that still gets you into the point of money. We're not dealing with money, but at the same time, you're looking at the rates where money is.
No, you see, it's not that. I am only trying to be, again, fair to you and competitive. So it's like if you're going to this meat store and they're selling pound of meat for that much, and you're coming to the halal meat store, I want to make sure that I am somewhere in the same ballpark. It's not that because I'm giving you something that you need and I know that you're coming to use this, I'm going to overcharge you or set my own limits. I mean, business-wise, I mean, we have to stay within the competition. We have to stay reasonable in our offering. Yes.
Can you talk a little bit more about operational in 22 states? Does that mean you only...
Now 23. So, but operation, that means those are the states that we can offer, we are licensed to offer financing in.
Okay.
Yeah, so now 23 states, like I mentioned, but this is simply put, we are licensed to offer finance in those states. Which
so
is,
if you have a property outside of those?
outside of those, yeah, we cannot do it. But we try to, you see, we try to expand and we try to see where is the communities and more population and where is this needed, and we obtain the license in those states.
I'm just surprised. Some of the largest Muslim populations are in Virginia, in Texas, in
We
California.
are in Virginia.
You're in Virginia now? Okay.
With
the blue color is licensed state.
Yeah, the blue is...
Oh, sorry, okay.
Yeah, and actually, our home office is in Virginia. The headquarters of the company is in Virginia. Yes. Yes,
I have a question. Number one, do you offer financing help with commercial?
Commercial, no, not yet. I mean, this is something that's in the works, but it's, you see, the uniqueness of the contract that we offer, our contract is completely different than a regular bank contract. That makes it a little bit more difficult to get into different areas more. You see, if it was a regular bank contract, we would have been doing all of them. I mean, no problem. But because of the uniqueness of the contract, and then being also a non-recourse, being a contract that shares in losses, gives you, it takes us much more time to convince investors to come in and get into that. So, but this is in the works.
Second question is one with what he asked. Is there a maximum amount of money that I can
If
I do a new construction, would you help from the stage 1 to stage 3 all the way through it for a new home? Or is there a maximum amount of money that I really
we would help. I mean, you would contact us for the new constructions. We'll tell you how we can provide that. And as I mentioned to the brother, usually it is being done through working with the builder. So usually the builder will finance the construction and then will come in at the time of the completion of the property with the funds. So this is usually, I have never faced a problem with it personally. Very few builders will refuse to do this. And the amount financed is determined by county. So when you call us, which county are you planning to buy this in? We would tell you what's our maximum that we can provide. But usually it's usually enough within, because this is calculated based on the median price of properties. Yes,
My name is Nabil Eid. I'm the area manager for Illinois. I just want to answer a question because I have experience in the real estate also. When you do new construction, the regular banks, what they do, they lend money on stages for that builder to build it, like first stage to break ground, second stage, and the third stage. But because they are giving loans, and we don't deal with loans, most of the new construction sites and new builders, what they do is you put your down payment, let's say you plan to put down 10%, and they can wait till the completion of the house and the house is ready, and this is when we come in, we do the closing. Because remember, in Islamic financing, it has to be something tangible. That's why when you do money at the beginning to build the house, there's no house there. So that's what about Islamic, something tangible, something is there to be able to be co-ownership with it. That's the difference. Yes,
I have a question.
If you don't mind, let me just, you have a follow-up, sir?
So once you close the transaction, do you hold the note or do you wholesale it to Fannie Mae like most of the other banks?
Originally we closed with us, with Guidance Residential. We fund our own money at the closing and everything, okay? Freddie Mac, does anybody know, is Freddie Mac is a bank or anybody know? What is it? Government agency, they're not a bank, they're not a lending institution. Freddie Mac, they invest in our contract. And our scholars, they agree to that. There is nothing wrong with having investor invest in our, whether Freddie Mac, Fannie Mae, somebody else. And I explain it to you in very simple to you. Whoever is renting right now, have a side lease, let's say for 2 years, for example. And the owner of that building sells that building for somebody else. Does that change the lease? No, the lease stays the same. So it's the same concept. The terms, the condition, the halal way, the co-ownership, it does not change whoever owns that contract. Very simple explanation. I'm sorry, brother, let me just answer the question.
Let's give you an example. I bought a house, 500,000, okay? I put in half and you finance the other half. How do you determine what would be the installment per month and who's going to pay the insurance, who's going to pay the real estate taxes? Are there any documentation charges? I mean, how do you determine this amount? What should be?
Sure.
Because I'm living in the house.
Brother Bass, let me answer the question for you about the insurance and the taxes. The tax is your responsibility, and I tell you why. What's the reason people pay property taxes? Whoever owns a house, can I have a raise of hands, see who owns a house here? Why do you think you pay taxes?
You use the services of the county.
You use the service of the county. Who benefits from those things? You are as an owner. You're the one who lives in the house. It goes to I understand, but we're not living with you, brother. We waive our rights in that house at the closing because you are the one who's utilizing the house. And you are the one who's benefit from property taxes. For sanitation, for school system, for library, plus you're the one who gets the tax credit, the tax exemption. We don't file the tax on your behalf. You file it. Same thing with the insurance. If you want me to go more in details to explain it to you, this we have better understanding, I'll be glad to explain it. The insurance, anytime you buy a property, has an insurance. It consists of 3 parts: the structure, personal liabilities, and somebody in case he's too young, what they call it, personal items. Yes. So the structure itself, this is part of the insurance. The second one is personal liabilities inside, like everything inside, your clothes, your jewelry, and the third one is liability. Now, it's a bundle when you buy it, and this is how you get the cheaper rate from these insurance company. If you decide you want to break it and you want us to share it with you, we'll be sharing just the structure part. But for you to buy those other 2, it will cost you more than if you were to buy it as a bundle. So in the long run, it's a better deal for you to buy the insurance yourself. So that will explain that part.
You own 50% of the house.
Doesn't matter if you own 90%. You're the one who owns the house.
But you leave the insurance and the taxes to the other party, and the main question is, how do you determine what would be the monthly payment for the 50% your share?
Okay, we calculate your payment. We use something called profit rate. This is how it depends on your credit score, it depends on your down payment and all these things. We give you what is your payment will be. Our rate, profit rate, is very competitive with the market rate nowadays. Like Brother Bassem said, it's very competitive. We are the same, sometimes we are lower than the conventional banks, to be honest with you. Even our closing cost is cheaper than the regular banks. Yes, sir.
Question. Say I decided to buy a house today in co-ownership with Guidance.
Okay.
Okay. The house, suppose it's $100,000.
Okay.
Okay. And we decide, okay, I'm going to buy you out in 10 years. Okay. There's a recession. Things are bad. The house value goes down to $50,000.
Okay.
What's your loss?
Do you have to sell it? The question.
No, I don't have to sell it.
Okay. It's very simple. A lot of people
well,
see when
your share in the house has gone down. So am I going to be paying you as much as if the house is worth $100,000?
Exactly.
That's the question.
When we do the closing with you, brother, we do a contract. The house is 100, say you put 20,000, we put 80,000. The contract between us, and this is Islamic, we agreed on something that you're going to pay our $80,000 over 30 years.
Okay.
Nobody knows what's going to happen in the future.
Okay.
But also as a real estate, if the house value, just like what happened, the crash, 2006, 2007, 2008, you don't have to sell it. You can rent it if you have to. Or just continue paying for it.
Yes, my question is about the value of the shares. My share has gone down. Your share is down. So how is this co-ownership?
Co-ownership from the agreement at the beginning of the closing.
But at the end,
we are in good intention. The same thing. Like if the price of the house appreciates, the value of the house appreciates, we're not going to share that value. You keep all the profit. You have to take it both ways.
Actually, this question here is a very good question, and right now it is in the works because this question came up recently, and it was the cause of a disagreement between us and a group of scholars. I'm not sure if you're familiar with Amjad, Dr. Salah, and this was their main objection. They are saying now you would need to share in this loss if it occurs. And we are saying, you remember?
Because you are investing, you're not a bank.
No, I agree.
So if you're not losing, then there's an issue.
Exactly. I agree, but you see, our contract, you have to remember, was designed by also some scholars that this was their specialty. So, and they put this in the contract as this is how it works. Now, this group of scholars, this question came up from some customers numerous times, and then now it also was, like I said, it was a cause of a disagreement between us and the group Amjad scholars. And, but actually it's being recognized now and it's in the works. The way it works now is how he described it, as per our contract. But if it's going to change or not, this is very possible because this is something that came up a few times and it's being worked on. What happens if the value of the property depreciated? You see, on the other hand, we do not share in the appreciation of value. However, this is something that we give up. The other part is maybe you're right. So we cannot decide not to. So it's being worked on right now. It's something it's a question that's right on, I mean, and it's being examined.
Honestly, I've looked at conventional mortgages.
Right.
And I've asked so many so-called Islamic mortgages.
Right.
And I'm finding very little difference in the rate that is presented between conventional versus Islamic, several Islamic.
The rate?
Yes.
Yeah. Well, again, I mean.
One time you asked today.
Yeah,
I had a conventional 3%
yeah.
for 15 years.
I know.
And most of the brothers said, well, we are a little bit above this rate.
I know, but you see, the thing is...
I still have a problem in grasping the difference between the two.
Yeah, I explained this a little earlier, so I'm not sure if you were here or not. But the thing is, it is not, as I explained, Islamic finance or for a contract to be Islamically compliant, it's not about the cost and it's not about the rate. It's about the method of the finance and the structure, the way the finance is being provided. This is really what determines whether Islamically it is correct or not. Now the cost, we are trying to be as competitive as possible, right? You remember, we still have a cost and we have a goal, right, to achieve. But I mean, the thing is, the cost is really when you say that the rates is Actually, it is, we take it as a compliment when you say that the rates are very similar. Because the market is, the US, the mortgage market in the US is a monster. I mean, there are 300 different lenders that's available in the market. So for us to compete with all of with people as big as Wells Fargo and Bank of America, and those people are huge. For us to be able to compete and give you the same rate as them, this is, I mean, from a financial point of view, it's an accomplishment, to be honest with you. And this is the reason at the beginning, when you came, if you came to guidance in 2002 or 2003, this area, when at their beginning, they were more expensive. They required 20% down payment, and we were always being accused that we are overcharging because we are Islamic and we know people are going to come anyway. And but it wasn't. It was an affordability issue. Now we can afford to be competitive and to offer something as good as or as competitive to Bank of America and Wells Fargo and those guys. So it's really not. But again, after all, it's not what makes it Islamically compliant or not. We try as much as possible to be as competitive as possible. And let me go ahead.
Oh, sorry. Can you refinance and take equity out of your home if you need to?
Yes, you can. Yeah, this is available. But also let me put a little bit more on Freddie Mac. This is something that's very important, and it's a puzzle to a lot of people. So, however, if we understand how it works, it's very simple. Freddie Mac is a government-sponsored enterprise that was designed by the US government by an act of Congress. And it was designed to provide liquidity to the mortgage market. So they are an investor, they are not a lender, right? So Freddie Mac would not lend money to anyone, not to us, not to Bank of America, they are not in the business of lending money. They are in the business of investing in contracts. So they come after the fact. A lender is someone that I go to, guidance, borrow money from, and then turn around, finance you, and I make a profit in between the rates, which is not, this is not something that, this is what banks do. They go to the lenders like Federal Reserves, you know, those guys, or any other banks. They borrow money at a certain rate between them, and then they turn around and finance people at a higher rate, and their profit is in between. The investor is someone that comes after the fact, meaning I use my own money as guidance that we got from the mother company. We finance you and we have this contract closed. And then we go to the investor, say, okay, we have this contract that meets your guidelines. It's a good contract that will project it to generate that much profit over the next 20 or 30 years. Would you like to invest in it? They can say yes or no. Okay, we would like them to say yes, because if they say yes, this will provide us more liquidity. It wouldn't change anything in the terms of the contract. They will get to keep a part of the profit that it will generate, but it will benefit us a great deal that we can finance more profit, but has nothing to do with whether it's Sharia compliance or not. So we are not borrowing money from them. We are not, in fact, we are using our own money. They come in after the fact, and they can take it or leave it. And sometimes after they take it, they say, oh, well, we don't want to take it back. So I hope this makes it a little bit clearer how Freddie Mac works. Freddie Mac is currently back again to being owned by the US government, or owned and operated by the US government, and it was formed from the very beginning with the sole purpose of investing and keeping the liquidity of the mortgage industry, which was a very smart idea to start with. Yes, sir?
Now, the money you lend to the homeowner,
yeah.
You say we charge the profit rate, okay? Bank calls it the interest rate,
right.
Okay?
Right.
Now,
it doesn't matter what it's called.
If you determine that we own 50% of the house we're gonna find out how much is the rent in the area.
Yeah.
For that kind of house, it would have been nice.
You see,
but you are basing our payment on the profit rate. You can call anything you want. I don't see any difference between interest and the profit rate.
This is a very good point. Very good point. But you see, it doesn't matter what it's called. Like in fact, what it's called, right? What matters is the method of the finance, right? So if I, for example, give you halal pepperoni, would it be bad or something? It's beef, halal, no problem, right? So the word interest, you see, the thing is, this is, we have a lot of things that we're stuck on. The word interest in itself is not a bad word, right? It's just its association with the riba transaction that made it stuck in our minds as Muslims as something that's very bad. Now, those people, when they started this business of lending money and charging money on it or charging whatever they want to charge on it, they said, okay, they will call it interest. This is the interest we charge. If they would have started by calling it profit, we would have been using the word interest today in the Islamic finance, right? So they chose the word interest to describe this transaction, which happened to be Islamically very prohibited. So the word interest now became something that's very bad to us. Now, literally, the word is not what's bad. It's the description of what it's, the transaction that it's describing is what's really the problem. So guidance does not give loans, period. So riba cannot exist in Muslim. We only go on with you in properties. There is no money exchange whatsoever, right? Now this rent example was something that was on the table when they were designing the contract originally. However, how fair would it be if you're in New York and I'm charging you $2,300 in rent, and on the same priced property, a guy in Texas, I'm charging him $500 in rent, and he's your brother, and you come and tell me you're charging my brother $500 in rent. So you see, I have to have something that's universal, and in the same time would be competitive to the market, something that's reasonable to deal with. Rent was something that's on the table, we didn't cut it. It's a huge country, and differences between rents in different areas are massive. And equal housing opportunity within allow.
If I may add to Brother Basi, in Islam, making profit is not forbidden. There's nothing wrong with making profit as long as you make it the halal way.
As long as you
know,
our Prophet
he was a big trader. He was trading, making profit. Just don't do it the riba way.
What is the definition? Let's look at the definition. When you say profit rate, and then what is the definition? If I borrow $100 and you ask me to pay 1 or 2, what is the 2?
It's not,
you can call it profit or you can call it interest.
Okay, before everybody leave, if you don't mind, if you want to stop by the booth, we are giving away iPad, Kindle, and 3 gift cards. We're doing the sweepstake tomorrow night. If you want to register, it takes only 2 minutes, and inshallah you'll be the winner. I'm going to talk to you, brother, explain more details for you to understand.
No, we refinance also.
So if you have refinancing and the house has 2/3 paid off and there's a great equity.
Yes.
How do you decide how to help when the house has equity, but for example,
we appraise the property, right? And we would come in and share with you, we would buy from you how much it's worth to pay off your bank, right? So if this is like 10% or 20% of the property, so this is how the ownership will work. So we appraise the property based on the current market value. How much is your balance represent off of that percentage-wise? And this is how we come with you as a owner.
So you are not sharing anything in the equity?
No, we don't share equities. Equity is all yours. This is.
So in that situation where there's a $100,000 house, 80-20 co-ownership with guidance,
Right.
and then it's worth $15,000, let's say, in a year, and then you have to sell it. So where does that $50,000 go? Or does that
50,000 plus or negative?
$50,000 selling it, so it's $50,000 loss.
Loss.
Yeah.
We share in all types of forced sales. So if you're in a situation where you're forced to sell the property, meaning that, you see, normally, in normal scenarios, if you would own the property free and clearly, you would just keep it till this. So if you're forced to sell the property for whatever reason, sometimes you're forced to sell it because of what's called an eminent domain, where the county decides or the state decides if they're going to expand the road and your house is on the way. And they only pay a certain amount. They don't really deal with market value. They have their own assessments. So in all of those cases, you have to relocate. And you don't have, we will share in the loss. So we take the loss in this property. And this is one of the unique benefits of a co-ownership agreement. You wouldn't find even in other Islamic finance programs. Co-ownership, this is one of the very unique things of it. No money exchange whatsoever. So we will take a loss in our share, in our part of the property. You will take a loss in yours, so the loss here is shared. Versus in many other scenarios, you're taking 100% of the loss.
Is it based on percentage that you actually went into the co-ownership with? So 80% of the loss would be from guidance, or 20%?
It depends on the percentage at the time of the lot. Right.
That's only in the situation of a forced sale.
But
if you're doing a voluntary sale just because you want to move to another state, you still have to honor the contract between you and guidance.
Exactly.
Because you're the one who's breaking that. Correct. It's not us. That's right.
What in case of you're making profit? So let's say you bought the property.
It's all yours. Yeah, we don't share it. It's all yours. All of the equity is yours.
Okay.
Yeah, we do not share in the equity. So all of the equity and
you mentioned something about the parent company. So
yeah.
What's your parent company? Where they are getting their financing?
Capital Guidance is a company that's in investments and constructions and so in the U.S. and has been there for a while. The company is owned by a Syrian family from Syria, right? And it's a wealthy company. It has been there for a while. I mean, they have quite a few to offer.
The way the American banks work is they finance each other, they back each other up, right?
Yeah.
So basically,
No, we don't.
Running low, they have where to go to and how to get their money so they can copy themselves up. How's this guidance? Because when you invest, you want to make sure you've got your property.
Yeah, we don't have any of that. We're on our own, right?
There's no such thing as that on our own, right? You have to get money from somewhere.
No. So guidance, okay, started with $50 million, for example, right? I think this is the amount. And now, when we start this afterwards, the investor comes in play. So the money is being circulated through the investor, right? So the investor invests in the contract that's already closed with our own money, and it provides liquidity. When the investor invests in the money, he provides the cash, right? And will, upon collection of payment, he will keep a part of this payment, right? So this is how it works. But we are not, I understand the example that you're giving. Regular banks, you would finance, and after a couple of months, you would find the letter come and say, now you are with Wells Fargo, not Bank of America. And it's being sold as this business. No, you never happen with guidance. From start to finish, you'll be making your payments to guidance. This contract is never sold to another bank. Servicing is provided by a servicing company, which is, meaning servicing is the billing, people that manage your escrow balances, sending you the bills, collecting your payments. This is a service that's provided just like payroll, if your company gives payroll. But we do not sell you from day one till you pay up. You're going to write your check to guidance. Never change. Yes, sir.
For the property tax, do you also set up escrow just like the conventional system, or you late.
Yes.
You set up escrow.
Yes, of course.
And you will be paid monthly.
Of course. Yeah. Escrow is a part of this business. So
In case of
sometimes you have to. Sometimes it's an option for you as a customer. Sometimes it's not. It depends on the risk.
At what percent investment from the homeowner do you waive escrow?
Escrow?
Can you waive escrow?
You can waive escrow at 20% down payment.
20%?
Down payment, yeah. Or equity. You can waive.
20%?
Yeah.
In case of late payment, is there any penalty or?
Flat $50. Flat $50.
Yes. The difference, yeah, we are almost done. Just to answer the late payment, the regular banks, what they do, they charge a late payment fee plus they charge you interest on the late payment. With us, it's just the administrative fee up to $50.
Interest that compounds.
That's another
in the conventional.
How many months can you allow the homeowner to be in default before you make a decision about the future of the contract?
Depends on your communication. If you're communicating, then you can get quite a bit. But you see, you have to also understand that this is, there are rules that's enforced by the state. So foreclosure is something that's enforced by the state. Yeah, after the state will, I have to be in compliance with the rules, I have to foreclose after a certain amount. This is to provide what's called an equal housing opportunity. So the state law cannot allow someone to be in default for how many, and then the next door, if they default for 3 months, they get foreclosed. So this is regulated. So inshallah, this will conclude our session, and we thank you very much for being here. Our booth, as Brother